Well, folks, we've got another dud set of earnings. The latest name to disappoint is unfortunately another gold miner, Eldorado Gold, who on Thursday reported their third quarter financial results, and well, they were rather meh. Let's just say the company isn't exactly making money hand over fist despite the current gold environment. I guess everyone can't be Agnico Eagle. Folks, we're talking earnings, we're talking Eldorado Gold, we're talking General Gold. Let's dive in. Okay, so Eldorado Gold for the third quarter reported production of 125,000 ounces of gold, a modest 3% increase on a year-over-year basis from 121,000 ounces in the year prior. Gold sold, meanwhile, amounted to 124,000 ounces at an average price per ounce of just under $2,500 per ounce, which is a substantial jump from the $1,879 per ounce the company earned last year. This led to top-line revenue of $332 million for the quarter, a 35% jump on a year-over-year basis. Again, this was largely due to something outside of Eldorado's control: a rising gold price. All-in sustaining costs, or AISC, came in at $1,335 per ounce, a 13% climb versus the year-ago period's $1,177 per ounce. As we've said in other recent earnings coverage, this rise in all-in sustaining costs is largely attributed to a rising gold price, which causes the costs of royalties to climb, negatively impacting AISC. Not a huge deal, really. Net earnings for the third quarter came in at just over $100 million, or 49 cents per share, compared to a loss of $6.6 million, or 3 cents per share last year, with the improvement driven solely by the gold price environment. Analyst consensus estimates had called for earnings of 33 cents per share for reference. Adjusted EBITDA, meanwhile, came in at $169 million, an improvement over the $109 million recorded in Q3 of 2023. Yet, despite the jump in revenues and improvement in net earnings, Eldorado still failed to post positive free cash flow. Free cash flow came in at negative $4.8 million versus negative $19 million in the year-ago period, with the company blaming the failure to post positive free cash flow on the investment at the Skouries project. The company then went on to state that excluding Skouries, free cash flow would have been positive $98 million. Eldorado finished the quarter with cash equivalents, and term deposits of $677 million, a substantial improvement over the $595 million recorded as of the second quarter. And then there's the guidance. While Eldorado on a technical level didn't cut guidance, the firm tightened their estimates. The forecast for gold production has been reduced from a range of 505 to 555,000 ounces to that of a range of 505 to 530,000 ounces. The impact here is a reduction in the midpoint of the guidance range, which fell from 530,000 ounces to 518. At the same time, cost guidance is now on the higher end of prior estimates, with the previous range for all-in sustaining costs being reduced from $1,190 to $1,290 per ounce to a range of $1,260 to $1,290 per ounce, effectively raising the AISC guidance midpoint from $1,240 per ounce to $1,275 per ounce. Not exactly positive. The rise in costing guidance is said to be due to lower production and increased royalties related to a higher gold price. Now, the previously mentioned free cash flow issues can be attributed to the Skouries project, but it's actually not the worst thing in the world. For those that are unaware, Skouries is Eldorado's up-and-coming copper-gold project in Greece. The project is said to be currently 79% complete, with first production slated to occur in the third quarter of 2025. The new mine is expected to contribute 50 to 60,000 ounces of gold production to Eldorado next year, along with copper production of 15 to 20 million pounds, with commercial production slated to be achieved by the end of 2025. Once complete, the mine is expected to produce 140,000 ounces of gold and 67 million pounds of copper annually over a 20-year mine life. Elsewhere across its operations, in the third quarter, Eldorado managed to sign a collective bargaining agreement at Olympias, with the agreement said to also support an expansion of underground operations, moving the mine from 500,000 tons per annum to 650 over the 15-year remaining mine life. The company in the second quarter notably was negatively impacted by work stoppages related to the Olympias mine. Finally, the company has also suffered some maintenance issues at Kışladağ, leading to lower tons stacked than planned, while recovery issues have also been identified due to particles not being fully grinded to spec. Okay, we're not going to pretend there was a huge investor response to the earnings, because despite having annual production of 500,000 ounces at a market cap of nearly $5 billion, there just isn't a lot of commentary on the name. Perhaps it's a sign of the times, and I suspect at some point people are going to start to give a shit again. But anyways, most of the market reaction that did exist was actually quite positive. Even Mark over at IKN was quite positive, and I don't know that he's ever been positive about anything in the mining sector, so Eldorado must be doing something right. In fact, we might have been the most critical coverage on the name, and that was largely due to cash flows being negative. Okay, so let's wrap it up. Was the quarter a home run? Not really. But to Eldorado's credit, they're in the middle of a major build out at a mine that has a capex of nearly $1 billion, and they haven't blown out their balance sheet to do it, which does mean something. Once that project is online, which is now less than a year away, it should meaningfully improve the production profile of Eldorado while providing some metals diversification. With that being said, they're going to have to start returning capital to shareholders at some point down the road. Now, at current cash flow levels, that simply can't happen. But all that being said, we are noticing a huge uptick in the engagement, subscribers, and likes on our channel, which, by the way, if you haven't, smash that like button, subscribe, and ring that notification bell. But I have to say it's because we've been covering gold for a couple of years now, and people really didn't care that much, quite frankly, until now. This last month, everything's changed because the price of gold keeps going up. When we talk about companies that are producing hundreds of thousands of ounces of gold a year, you have to look at them and say, how big of an impact is it going to have on your cash flow when you go from $2,000 gold to $2,800 gold? We look at Eldorado Gold, and a lot of people might not be paying attention right now, but they're going to be, because every portfolio manager that's looking for places to put money that is actually going to yield some cash flow at some point is not going to be able to ignore the gold sector any longer. And that time is coming up right now. I believe that 2025 is going to be a massive year for gold names, and especially those higher end names like Eldorado. They're basically a tier below the big boys. And I think that we're going to see quite a bit of eyeballs, quite a bit of investment going into Eldorado. And it's a name that if you are following the sector, you're going to want to keep an eye on. All right, everybody, thanks for watching. Let me know what you think in the comments.